You don't want to go into ventures where you can lose everything. You want to broaden your diversification. So you want to have high quality types of investments, which themselves are diversified and well managed, actively managed, and so on. A diversified portfolio, let's say, of diversified portfolios. So it's a fund type environment.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, hey, investing in these perilous times, definitely risky, or it can be. You need a focused strategy that will keep you safe and keep the money flowing. And that's why we have a special guest for you today. He is known as the Income Coach. He's been doing this for 40 years. His name is Steve Selengut. Steve, it's great to have you on the show. So how did you become the Income Coach?
Well, Kerry, I guess it's a long story. I actually became a private portfolio manager back in 1979 when I started a business where I was managing portfolios for other people in addition to my own. And then that kind of grew up for 40 years until I finally sold that business in May of 2023, almost 2 years already, and wrote the book called Retirement Money Secrets. And with that, I developed an income coaching business. And I actually call it, income independence coaching, where I try to bring people to a point where it doesn't really matter which way the market goes or which way interest goes. Their income will keep right on growing regardless. And it's what I call income independence.
Interesting. And so how do you achieve this income independence here? It sounds great, but if it isn't practical, then what good is it, right?
Exactly. It's simple and maybe a little complicated at the same time. The simple principle are four. I mean, basically what you want to do is, particularly as you get older, is you want to try to minimize your financial risk as much as possible. You don't want to go into ventures where you can lose everything. You want to broaden your diversification. So you want to have high quality types of investments, which themselves are diversified and well managed, actively managed, and so on. A diversified portfolio, let's say, of diversified portfolios. So it's a fund type environment, but not your normal fund type environment. I don't use mutual funds, and I only use a select few ETFs, and then only for very large client portfolios do I recommend them. And then there are two other items. The third item that you want to make sure of is that you have significant income and a growing amount of income coming into the portfolio. And the fourth and final thing is that you don't just sit back and set it and forget it like perhaps your advisor wants you to, but you take profits when they appear. The stock market doesn't always, it goes up. Yes, it has gone up. Yes, over the decades, but it hasn't been a straight line, and it will probably never be a straight line. And when a price of a security goes up, I take my profits and I move on to another one. It might be a quite similar one. It might even be the same one within a reasonable number of days. But I constantly take my profits, thus adding to the capital that I have that produces the income that I'm trying to grow.
Okay. So like you said, the market always goes up, but the tree does not grow to the sky, right?
Depends. Right now, it's right about the sky in the stock market, but not the bond market. But anyway,
The tree can only go so far.
So far, exactly.
So 40 years of experience, knowing what you know now, if you could go back to your 15-year-old self when you started in the business and tell yourself what you've learned, what to avoid, give yourself one piece of advice, what would it be?
What would it be? The main thing I wish I had done sooner in my career, and that would go back to when I was 34 or so, or 25 when I actually started investing, would have been to discover closed-end funds sooner. If I had done that, I would be worth multiples of what I am today.
Okay, which I'm sure is not insubstantial, so you'd be worth even more. All right, closed-end funds. I know there's something about them. Sometimes they trade, there were funds that were set up unlike mutual funds where there's a fixed number of shares, nothing else gets issued, and then they go out and they buy securities, whatever it might be, whatever the name of the fund was, that's what they would buy. And oftentimes these closed-end funds sold at discounts to the underlying stock portfolio that they owned, which was like if they were Dow S&P 500 closed-end fund, you could buy the S&P at sometimes a 10 to 20% discount. I don't think that happens so much anymore, right? So that's obvious, right? So how did people miss this?
Okay. Well, there's a couple other things about closed-end funds that are important to appreciate. They're different from the other funds out there. And you just pointed out one significant one, that they don't have their price isn't manipulated to equal their net asset value every day like they are with ETFs and mutual funds. But the other significant difference is that they are required as pass-through trusts, which is what they are created as, to give 95% of their net earnings to their shareholders. So they're a different breed of animal. They're not designed to grow in market value, not designed to grow in price. They're designed to produce income for their shareholders. In an ideal world, this is the way stocks in the stock market would behave a little bit more closely to this, where they would pay their shareholders at a rate that somehow relates to what they pay their chief executive officers.
Question for you, Steve. How do you pay that out? Do they pay it out as a stock dividend? They pay it out as cash? Can you reinvest that? And are we talking just, how do they pass along these profits? Are they trading profits or dividends? How's that work?
They're both. They're trading profits. They're premiums on options trading in some instances. They're dividends, they're interest and principal on mortgages, for example, and so forth. There are all kinds of different securities inside. They typically pay monthly distributions, and the current rates right now at today's prices are a little over 10% for income-focused ones and 9% or better in the stock market. So
I like that. So 10%. So you're basically, maybe you're keeping up with the true rate of inflation, not the stuff that they're telling us, but right?
Except for good restaurants, I think you probably are. So yeah, I love it. So closed-end funds are different in those ways. And their biggest difference, of course, is they throw off a lot more income. So there's a lot of chances to reinvest it. You can reinvest it automatically, but I'm not a big believer in automatic reinvestment. I like to do it selectively. I don't like to buy into a security at a price higher than my cost basis for that security. Right. I like to, particularly with these, if you reinvest selectively, you can pick to add to ones that are down in price, so you can actually increase their yield while reducing the cost basis overall. And that's one of the strategies I use.
Okay, we're not asking you for advice here, even though I know you're licensed and all that. But can you give us a few examples of such funds?
Okay,
Recommending?
Yeah, I'm not I'm not recommending. There are. I'm going to give.
We gotta
I'm going to give you some numbers here.
Mhm.
Okay, I call my the spreadsheet I use to choose my, the ones I've selected from a website called CEF Connect, which lists and analyzes all 400 or 500 of them. I've selected 105 or so that are income focused, that invest in things, preferred stocks, bonds, mortgages, etc. And there's about over 100 of them. For example, BlackRock, a BlackRock floating rate fund, a BlackRock, Blackstone long and short fund, and then there's Calamos and the symbols on those, which, well, these are not recommendations. I'm being forced to tell you these names, but there are over 100 of them, and these are just samples. The BlackRock fund called BGT that you could look up at CEF Connect. A Calamos fund, CHI, you could look it up at CEF Connect and see what you think about it. I would not buy anything unless you do complete amount of research on it.
Hey, so I have a quick question for you, because these things kind of came up in the 20s. I think they started.
The 1820s.
Yeah, they've been around. I know they've been around for a long, long time. Are they still making any new ones here? They are doing it. What?
Yeah,
they get a higher fee for these companies. The fund managers, they get a higher higher rate.
The managers, the charges that they put on the website and each one, which we never pay. All the yields I mentioned are net of all expenses.
Right.
They do charge 2.5%, 3%, 4% sometimes. Too much to be included. The government, they're not going to be in your 401k because the government won't let anything in there over 2%.
Really? So I'm just looking at one here that I just popped up at random, the Nuveen Real Estate Income Fund. Its total market value, $221 million, distribution rate, 8.9%, which means if you put in $100, you get $8.90 back.
Mm-hmm.
And it's trading at a discount to net asset value of 10.2%. Its expense ratio, they're really high, 3.64%. Is this something I should think about?
Absolutely. What's the symbol?
Better.
What's the symbol?
The symbol. Why'd you ask me that? Hold on a second. Let me find it. Let's see. Of course, it's a sponsored company. I'm just looking at Kiplinger. Let's see what we got here. Let's do a little Google search here. Darn it. Give me 1 second here. Actually pretty good at this, Steve, but sorry, I'm doing this like real time here.
Yeah, me too. And I'm going to look at it and see if Connect is.
Okay.
Tell me.
Here we go. JRS.
JRS, yes. JRS. Yeah. JRS is as you might have guessed, it's on my list.
Oh, okay.
And I've traded it for many, many years. But if you look at it, you just mentioned a couple of the basics, but you can click on, if you looked at the distributions, you'll see that it's been paying a regular quarterly distribution since at least 2002.
Yeah.
And
that's a good thing, right?
Yeah.
It's 22 years.
Yeah. So when you look at it and you're doing your research on any of these funds, which you must do, you want to look at the distribution history over time. Okay. You want to look at what's inside. This particular one, it's in real estate. So it owns stocks of some companies and preferred stocks of other real estate companies. It has only 85 positions in it, which I'm saying only, that's a lot of different companies, so your diversification, your investment is pretty safe. And you can also find out that 15, 19, 25, 30, about 35% of the portfolio is invested in the top 10 companies. So 35 in the top 10 and 65, which with less than 2% invested of the assets.
Okay.
So it would be comfortable. It would certainly be in addition to most of my portfolios. This one happens to be, since it's mostly stock, I consider it an equity fund, not an income fund.
Okay.
But still, at that yield, it's a nice thing to be in.
Yeah, and they're investing in REITs and stuff like that.
Yes.
So these funds been around. A lot of them you're investing in a long time. Do you only buy them at a discount, or do you buy them at par, or will you pay a premium for them?
Okay, you have to understand that these. Let me put it another way. Do you care what the intrinsic value of a share of Microsoft is?
Well, it's
But do you think do you think it trades at its book value?
No,
there isn't a stock out there that trades at a book value.
Unless
closed-end funds,
business.
Closed-end funds are exactly the same.
Yeah, they
are a function of supply and demand for, let's say, a real estate investment that pays you 8%.
Yeah,
if there's more supply than demand, it's going to trade at a premium. Otherwise, it's going to play at a discount. But let's talk another thing. The securities that make up all the shares of these companies that make up the net asset value, some of them are interest rate sensitive, particularly in the income sector. So you could have a fund that has 1,000 different treasury bonds in it, guaranteed by the federal government. If interest rates go up substantially, or even a little bit from what they were issued at, they're going to trade on the markets. They're going to trade below their face value. Sure. So the net asset value is going to go down, and it could go down substantially. And at that point, you'd say, okay, if there's more demand for that fund now that it's paying 8% at this discount, this internal discount, that demand might actually pull the price of this stock above net asset value when all the securities inside of it are trading at a discount.
Okay, so but you've been studying these things for 40 years now. When you see them at a discount, is that an alarm bell, a red flag, or is that a good thing, or it's irrelevant?
I consider it irrelevant.
Okay.
Because it's the natural state of affairs. It depends on the prices of all the securities inside that fund. And everything from the situation in the Middle East to, planes flying into buildings to problems at the border are going to impact the prices of the securities out there being bought and sold every day in the financial markets. So I don't buy securities to keep them.
Right.
I consider securities differently than most people. I have, like I said, in my own portfolios and in the portfolios that I managed for people for all those years, I had a lot of positions in each of them. And I treated those positions just as I would if I were running a department store. And I had all these goods and services on my shelves that people would want. And I'd had a markup on them of where I would take my profit. I would sell these things. And that's how I operated an investment portfolio. So if I have that JRS in my portfolio and I assign that I have a 5% markup on it and I can sell it at a 5% profit, I'm going to do that sale immediately. And I'm going to buy another closed-end fund that has similar securities or maybe even not and put it into my portfolio, onto my shelves of my department store and put a markup of that 5% on that one and hold it only until it goes up in that price. And then I'm going to sell it. So some of these things I might be holding these things a matter of days or a matter of months.
Cool. I'm liking the system here. So what kind of returns have you realized over time using this?
My standard thing is that 10% a year in actual realized gains in my working capital are a reasonable expectation. Because I know I typically I won't even buy a closed-end fund plus it's paying over 6%, and that's under any market conditions, even when interest rates are in the zero area like they were recently. So I know I'm going to do that, and I know I'm going to trade. For example, this year, I have 7 months income, the equivalent of 7-month income, just in capital gains this year. Yeah.
So you're not, even though you're an income coach, you're not really holding on to it for the income, are you?
I'm doing both. I mean, there are two streams of income. Stream one is the distributions. And let's say we go into a 2022 or worse, and the market goes down for 18, 24 months. The income from the distributions is going to pretty much remain the same. The profit-taking opportunities are going to be few and far between. So you may have years where you're relying strictly on the income from the distributions and without the bonus of the capital gains that you can either spend or reinvest. So it's not always as good or as easy as it was this year.
Yeah. Well,
2021 was even better.
You're opportunistic, right?
Yeah. How many times have you seen, let's say you invest in the stock market and you hold them, even the FANG stocks or the Dow 40 or whatever it is, you own them. How many times have you seen them be in a great big ego building profit position, and then it disappears like it did in 1987 and 2000, 2008. March of 2020. It happens all the time. There are always corrections. And my goal is to leave as little as possible on the table.
So you figure you're shooting for a 10% return on your portfolio annually?
I expect to make a 10. I don't use the word return in the industry. Return means the change, the growth in the market value.
Right. You're saying total return.
And that's total return, gain in market value plus any income you received. I'm saying gain in working capital, meaning the amount of money I have invested in the securities in my portfolio. And that grows by income production, deposits, and profits.
So is this something you want to put like into a retirement account where you're not paying taxes on it?
It's perfect, particularly in a Roth IRA. I mean, if you can put 10% income producing securities in a Roth IRA, even if you don't take the profits, it's going to double every 7.5 years, right?
That's great.
If you can add even 2 or 3% in profits each year, it's a virtual gold mine.
Yeah, money.
Put it in a Roth IRA, exactly, a money machine.
All right. Well, I like it. Steve, tell us where we find you, how we connect with you on the interwebs.
The interwebs. The best place to do it is to pay the cheap price of $10 or $20 for the Retirement Money Secrets book. And it'll tell you where you can go, how you should approach it, where you can go to find these types of securities and research them, and also how to contact me if you want help. And my website is theincomecoach.net.
All right. Excellent. Well, we really appreciate you coming on here. If you got any questions for Steve or myself, shoot me an email, kl@kerrylutz.com. And the link is in the show notes to his book. And while you're there, on financialsurvivalnetwork.com, please sign up for your free newsletter. Steve, been a real pleasure. Thank you so much for coming by.
Thank you, Kerry. Good talking to you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.